All right, we are going to get rolling, and so thank you guys for joining us for our conversation this morning. I know it is it's Friday morning, and hopefully you guys had an enjoyable night and enjoyed the opening plenary as well. So this session, if you are in the right place, which I hope you are, we're going to talk about financial innovation in the real estate sector, in the real asset sector. We're going to talk about buildings, and so you have picked the right room in the sense that we have a really truly an expert panel, and hopefully you're going to join us in a conversation about the state of the kinds of financial tools and innovations that folks are using to be responsible, engaged investors, to find returns, to generate better buildings in the property space. Reminding ourselves what we probably don't need to be reminded of is that we are talking about the world's largest asset class. And thus we have an outsized impact on both people and the environment, as well as an outsized opportunity for returns for many, many different kinds of investors. So I want to start without much further ado. And so I'm Chris Pyke, and I'm joining from the perspective of the U.S. Green Building Council. I also work for GRESP, which provides ESG information for institutional property investors. And I want to run down this expert panel and give you a sense of the breadth of knowledge that they have. And so I've challenged them to tell you and to tell each other about who they are and what they do. I had told them 60 seconds, but they then added this who they are thing, so we're going to give them an extra 30 seconds. So I'm going to give them 90 seconds to kind of give that pitch about what it is to help you understand where they're coming from and what they do in this space. And let's start. Lisa, why don't you dive in?
Sure. Good morning. My name is Lisa Bozzelli. I am at Fannie Mae. So the Fannie Mae multifamily business essentially supports the secondary market for commercial real estate, specifically apartment lending. We work through a network of about 25 lender partners, enabling those lenders to go out and then create more financing opportunities for borrowers in the market. We issue about $65 billion last year in single loan, single pool mortgage-backed securities. 40% of that business was done through our green financing business. So essentially, we go out and encourage borrowers to make energy or water consumption and reductions in their properties, their existing properties, or to seek a green building certification on their newer properties. So that product, again, 40% is now totaled $40 billion so far in our portfolio. I'm on the capital market side, so our trading desk essentially is an investor in that space, and we compete and we restructure on the MBS that we do buy, resecuritize into the market through our REMIC structures.
Awesome. Tsilah.
I'm Tsilah Burman, and I'm with CBRE Global Investors, and we are a real estate and real asset investment manager. We have $107.6 billion in assets under management. And what I do is I am the global head of our RFP team, so we respond to all our proposals for new business and create the private placement memoranda and other marketing materials, and we answer all the ESG questionnaires that come from investors. And then I also serve on our Global Responsible Investment Management Committee and our America's Responsible Investment Management Committee. And we serve our investment teams and our corporate governance to ensure that we're integrating ESG factors into the whole investment process.
I'm Dara Friedman. I'm with Bentall Kennedy, which is a North American investment management firm. We have about $40 billion of AUM, roughly 60% in the US and 40% in Canada. I'm on the portfolio management team, so what I do is identify strategies and assets for our institutional clients in our various funds and separate accounts. And our corporate focus has been to employ sustainability as a upfront value creation mechanism, and then also in the asset management of our buildings to create value.
Cool. Great. Paul.
Good morning. My name is Paul Mathew. I'm a staff scientist at Lawrence Berkeley National Laboratory, and no, I did not lose my way here. You'll see in a minute why I'm here. So most of my work is on research on energy efficient buildings, particularly developing technologies and strategies to make buildings, to reduce the environmental impact of buildings and improve their indoor environmental quality. So we do a lot of testing, technology development, validation, field testing with partners in industry. And one of the areas we've been working on lately has been looking at the relationship between green or energy efficiency features and financial value, and understanding empirically what those relationships look like and what that means then for people investing in buildings. So that's my excuse for being here.
Awesome. So what I want you guys to take from this quick run through is that rather than diving particularly deep into any given aspect of financial innovation for property, what we have is an incredible survey and cross section of different aspects. So just to kind of recap, and as we go into this, the first set of questions I'm going to ask the panel is about the state of the market. What's working, what's growing, what's having impact? And I want you to just capture in your mind's eye that we're talking about innovation ranging from multifamily mortgages affecting a very large percentage of the US. We have innovation in the high-end commercial office space. We have innovation in the B and C spaces, the value space, and we have innovation in the basic understanding about what's the relationship between, say, commercial mortgages and default risk. So we're going to touch on all of those over the next few minutes, and even that is just a sample. But these guys can talk about much more than just that. So I want to run down the row and kind of give a sense of what's the state of the market, what's working in your niche, and what are you excited about? And
Sure.
Lisa, please.
Sure, I'll jump on that. So we are a relatively new product in terms of green MBS backed by mortgage-backed securities for multifamily, especially in the United States with a focus. So for us, it's at this point all about education. So we'll talk about the success of the program, but it's largely based on educating the borrowers about the cost savings that they'll realize through this technology. And then the lenders. The lenders for us is really the interface with the borrowers. And so until you get them on board and they see some benefit to their borrowers, it's hard to convince people to approach the product. For us, the lucky part from an investor perspective is it's a tack-on product, so it looks exactly like our regular 30-year-old DUS MBS. So we are continuing to track. It's still too early for us to talk about default behavior compared to our regular non-green MBS. But in our minds, basically, as essentially insurance providers to these assets, any asset where you get a borrower to make an improvement, a capital investment, has a better chance of succeeding at the end of the day.
Can you just before we go to Tsilah for a second, can you talk about one of the neat things about what you guys have done? I mean, it's really incredibly, you're very modest about how it works, is that you are driving people you are helping people make specific and tangible improvements, just to help people who may not be familiar.
Sure.
What are they doing?
Sure. So the easiest one is the green building certification on a new asset. But frankly, if you look across the United States, and we are by rule only focused on the United States, the existing multifamily assets in the country are roughly 38 years old. So they're not pretty, they're not new, and they're very unlikely to be torn down and creating a new building. So for us, it was about trying to bring these older assets up to speed. And so we incentivize the borrowers to either make energy or water consumption improvements. So we're talking toilets, faucets, the most basic, to also renewable energy. We have an incentive program. Essentially, they will get a lower loan rate on that deal. For us, that loan rate is coming from us, not from the investor's portion. So we get a guarantee fee as an insurance provider. We reduce that because, again, to our earlier point, it's a lower risk option for us as an investor. It makes sense to take that newer asset and put it back out in the market with a lower rate. So we've been able to bring people forward on it, but largely data, which we'll get to with Paul, has been a big driver for us because we do have ongoing disclosure. We're commercial properties. Even our affordable is a commercial for-profit entity that is lending on an affordable property. So they have annual reporting requirements, and we are just tacking on the green reporting requirements on top of that. So we're fortunate in that element.
It's incredibly impactful. All right, so what do you have a different lens. Talk about what you're seeing in the market.
Well, I'm quite excited about what's happening at CBRE Global Investors and what I see also in the broader market, in that I think that a few years ago, I mean, we've been in this space in sustainability since 2007. 2009, we became a signatory to PRI. But what we've seen is in the last 2 years that there's been a broader emphasis on ESG, where it's not only the environmental piece, but it's the S and the G as well. And especially the S is becoming more important. And in the S, it's not only it goes into that health and well-being piece and how we engage with not only our tenants, but with the broader community. And so that's exciting. We recently just reorganized our responsible investment management approach so that we have a global responsible investment management committee, and we have both regional and business line RIMCOs, what we call them, that are working again with our investment teams and ensuring that we're looking at all the various ESG factors. TCFD, we've heard over and over throughout this conference, is I think something that we're all taking a look at, and how we incorporate that. One of the things that we've done is that we're doing ESG strategies specifically for each of our funds, and working with our separate accounts that are interested in doing that. Again, going into particular creating targets, reduction targets, and KPIs around that.
Awesome. And if you guys haven't, for folks who maybe haven't followed, there's so many different facets to CBRE. Just comment on one is saying that they have been leading the way in defining what healthy workplaces are and making them available to premium tenants, and your headquarters in Los Angeles is one of them.
Yeah, we have proprietary operating programs for our office properties, retail properties, and multifamily properties, where it is about creating an experience for the tenant, and also creating health and well-being amenities and approaches and programming that will add to the experience. And what it does is create greater tenant retention, which again then relates to our bottom line and our returns.
Awesome. All right, Dara. So you bring a different focus, and just for the benefit of, we have some folks in the room who I'm sure are not property investors, or maybe they're just curious. Can you talk a little about the strategy space that you exist in, and how these issues are different for you, or maybe overlap, and talk about your business?
Yeah, no. Well, it's interesting as it relates to the lens right now on the investment management side. You know, everybody's focused on where we are in the cycle and how you sustain and create value. Yeah. So I think one of the things that we look at having a Canadian DNA as a company is we have always operated as a company incorporating certain sustainability measures. And again, I think it has been more holistic. So I actually have been with Bentall 2 years. I came from another investment management shop that was very value focused, less sustainability focused. So it's been interesting to see late cycle, how do you identify and create growth? And I think our one of the tenets that we use is sustainability. So we've been able to take some of the things that we've seen succeed in the A space, and a lot of that is creating, very core properties that are have a lot of great amenities and for wellness and transit oriented and all that other stuff. And then how do we apply that to the value space? So when you're in B properties and you're investing with a value add cost of capital, which is a little more expensive and a little higher octane, how do you incorporate sustainability to ensure some of that growth versus just making money on the buy because we're not at that point in the cycle anymore? So that's one of the things that we've been really focused on is, what are the upfront measures, what are the asset management measures to ensure a chunk of your value can be identified and created from the sustainability component versus just leasing vacant space or building new space and delivering it. So that's one of the things that we've been very focused on. It's very nuanced. There's not a lot of data on it, but we're hoping to translate the data and the growing mindset that's been achieved in A to the higher cost of capital strategies.
And that's really, thank you for setting that table. And I want to just echo that when you think about what we understand, for those of you who may not follow this incredibly closely, the issue about what's going on, this distinction between how does high performance green building work in Class A, trophy, landmark sorts of things. If you look at, we've seen research both by Bentall and by CBRE telling us about how that market works in terms of premium, effective rents, tenant retention, marginal value on sale. We've also seen things like there's something called a green building adoption index that shows us that over 75% of core CBD assets are in this space. But that's not the BC space, and it's not the value space, and so some of these things are these distinctions. And for those of you who may not follow the property, this is when we talk about why is it different to invest for responsibly into property, is understanding these real differences in how the property industry is organized, and why certain aspects of high performance work in A, they may not work in BC, and they don't work in other things. So Paul, just we'll turn to you for a second, and we'll come back for a circle here. You're saying, all right, so you're the big brain data guy at this table, and so there's a lot of things that you just to kind of give Paul a little bit of this. Paul's worked on all sorts of stuff. Like if you want to know which energy efficiency measures save money, if you want to work and variety of stuff, it's all big brain data, big data set stuff. But in this context, talk to us about what you've done in the commercial lending thing. It is not where Fannie Mae has been. It is like if Fannie Mae is doing $40 billion in green-related residential mortgages, there is no equivalent in commercial. But everybody kind of goes, shouldn't there? What have you been learning about the commercial lending space?
Yeah, thanks, Chris. Right, indeed. And to your general question that you were asking just now, which is what's exciting, I think it's the data space, and I don't say that because I'm a researcher, but I think trying to get empirical evidence for the value of green as it relates to asset value, to me is very fascinating. And so this is one of the questions we've been looking at over the last couple of years in collaboration with UC Berkeley, is just looking at the question of commercial mortgage default rates and how that relates to energy efficiency and energy risk, if you will. And frankly, I was a bit of a skeptic because I felt there would be too much noise in these data to actually be able to see any signal out of it all. But surprisingly, what we did is we matched mortgage default risk data, with energy data from these buildings in terms of how much energy they use, what prices they're paying, and so on and so forth. And lo and behold, we actually found a statistically significant correlation between default risk in commercial mortgages and both energy use and energy price. So basically, buildings that use more energy per square foot essentially had a higher default rate, and again, statistically significant. So this was, to us, very interesting. And that's fine from an analysis standpoint. What was, to me, more exciting, actually, is that we then actually took that to some lenders. And we said, hey, we're just curious how they'd react to it and how they saw it. And some of these lenders, again, they're not efficiency champions, they're not green champions, they're underwriters. Their job is to look at risk. And so they were intrigued, and they said that, wow, one lender, in fact, I'll quote him, butchering his quote a little bit, but generally he said, I have to say, I've never thought of energy before. Of course, it makes sense because it's a piece of NOI. And so, all other things being equal, less energy means higher NOI, right? So it should affect. But I've just never thought about asking about it. And this makes me think I'd want to ask about it. So right now we're working with a few lenders to pilot an idea of an energy risk score that they would incorporate into their underwriting practices. And so, if you have a high score, if your risk is high, in other words, you might get hit with a slightly higher premium on your interest rate, or you might be asked to do certain mitigating measures, or if you have a lower risk, that they might be able to offer a discount on your interest rate, for example, just like Fannie Mae is doing with multifamily. But we'd like to see that expanded into offices and retail and so on. So. Yeah.
Awesome, that's exciting. All right, which leads very nicely to the next question for you guys, is saying, so a lot of this stuff is new, and as Paul was filling in a data gap of, hey, what are the loss rates and so forth in commercial lending. What are some of the data gaps or understanding gaps that you guys are fighting against? Some things that we don't know that are holding you back? You might also spin that question around and go, if you could know some things that we don't know right now, what would help scale your businesses and scale the activity? So
sure.
Back to you for a
I think for us, to Paul's point, it is the data, right? Even if you do have reporting from a borrower, it's still a borrower who's inputting the data manually. And so we're constantly culling through our data to try to see, does it make sense? Should we push a little bit more and confirm their numbers in a different way? But the availability of those data points, so in the early part of our project in 2010 timeframe, we were working with the EPA, as you know, to establish the Energy Star score for multifamily because it didn't exist at the time. We also had to do an audit. So these are all data points that provide data for Paul's big brain, essentially, and for our impact reporting, right? Because we have an impact reporting requirement. We'll be out this end of this year with an impact report for our entire green portfolio, but every one of our securities is one loan and has public disclosure. And so for us, it's just the veracity and the trustworthiness of that data. And I think to Paul's point about other commercial real estate sources, same thing. Like, how do you get that data? For us, multifamily is complicated. A borrower only controls a certain amount of his data information, right? A tenant is responsible for their utilities. So there is some lack of data that we're constantly working with the organizations to get to at the bottom, at the end of the day. But to your point, I think office should be the next. It's very doable.
Totally, and just kind of to praise, I'm going to be the Fannie Mae fanboy on this, but that, one of the things that as an investor you guys did was 5 years ago, you didn't have that, as you said, the data on multifamily energy consumption. So to some degree, you guys acted as a catalyst in the market to create the data.
We're not unwilling to throw our weight around.
And that's really, that's really laudable. I mean, so for other investors, you're going, if you're frustrated that there isn't data, Fannie Mae provides an example of saying, well, we're going to actually invest our time in that data. And that's actually not dissimilar from, actually, Bentall and CBRE have done the same thing in different ways. So we're going to go down the road. So actually, Tsilah, talk to us about what do you not know? What do you want to know that would make these things go a little better?
There are several things. One is data on weather vulnerabilities, so on geographic locations that are vulnerable to these weather events that we're resulting from climate change. So we're beginning to talk with our research group and also CBRE's research group to be able to come up with some sort of a risk framework for that, so we can incorporate that into our cash flow models when we're going to buy a property, so that we're sure that we put that risk premium on that property when we buy it, and we know what to expect. I think the other thing that's difficult is with industrial, retail, and multifamily properties. When we submit to GRESB, when we submit to when we talk in PRI, we don't have access to that consumption data if they're on triple net leases. So it's a matter of engaging with those tenants and hoping to try to help them to understand why energy efficiency is important to them, as well as for the greater good. So that's difficult, and I don't think we've, as an industry, come up with how to address that.
Yeah. I mean, those are the existential issues, right? And so if you're in one of those tech startups who are making those risk models, you can queue up here, talk to Tsilah about her interest in your product. But but that issue of the land, for folks who are thinking about why is property investment different, that relationship between the property owner and the tenant is just something that it's not the same as if you're investing in Toyota or something like that. We just have a different relationship.
Well,
Please.
One other thing is that, yesterday they talked about scenarios and and about portfolio construction, but it was for a portfolio of listed equity and fixed income. It didn't incorporate real estate and things that we could use as a real estate investment manager.
Yeah, that's yes. You're nodding and you're there. Some of these things are resonating with you.
Well, two points. Following on that point, I think in the real estate investment management space, sustainability has always kind of been wastewater energy focused, and it's not as, the capital markets haven't recognized the delta between regular asset management and sustainable asset management yet. To your point about, all triple net and just people focusing on portfolio construction with boards of companies and more easily measured sustainability metrics.
What's on your wish list?
Well, I think data. With a value lens, data. The lack of data is actually an arbitrage for us. So, as research is being done on correlation between energy uses and defaults, and the cost of capital may be changing for incorporating some of that energy efficiency. Our view is that if you can get ahead of that, and there will be a capital market compression for sustainable assets, and as they are defined. So, again, having operated assets sustainably for an extensive period of time within our portfolio, our view is that a leg of our growth, whether it's either creating alpha or mitigating risk, can be from sustainability. So that's the overall correlation. And I think as as we look at where we are in the cycle and how to define what we're buying and how sustainability relates to it, focusing on the risk mitigation component has been an easier digestion. So just very simply said, if you start looking at buildings that use less energy, some of those buildings may have operable windows and are not Class A buildings and are older buildings, and they may have been excluded by virtue of age, the age of their systems, and XYZ. But we can go in and say, hey, from an asset perspective, this isn't a really great market. Because I think we view sustainability both from a market perspective and an asset perspective. So you have A market, C asset, low energy use because of operable windows. You're not going to go in and change all those things, whereas like 5-10 years ago, you may have gotten dinged in the capital markets for some of those systems and ages. Now, because you're looking at it more from an efficiency perspective, it's actually a potential cheaper cost of capital. So the changing of the cost of capital as people get up to speed on what the data means and what's mitigating risk, I think is an opportunity for us to be ahead of as we look at value assets. So
that's super interesting. I mean, just to kind of resonate with folks is that issue of like the differential approach to BC assets that need, for folks who haven't followed it, many of you guys are familiar with climate bonds, right? And I'm a big climate bond fan. At the same time, climate bonds, for instance, defines a notion of being in the top 15% of the market. It actually, and those kind of strategies you were just describing are not, if you think you're a low carbon investor because that's what you're investing in, great, but the improvement potential, the reduction potential of doing the things you just described are huge, right?
But some buildings, they are, I mean, this is where I get like super wonky, but some buildings already exist like that. So again, I think when you separate what makes sustainability work and what are those identifying factors in growth markets and what markets can you create those in? Like we'll take market risk in secondary markets that look like primary markets because of human capital, transit, amenities, et cetera. We'll take risk in secondary buildings that look like primary buildings because of energy efficiencies, et cetera, et cetera. So I think that is, the data isn't there yet, but that creates the opportunity for a value investor.
Yeah, that's cool. All right, so Paul, you do some reaction.
Yeah, well, I mean, I don't have much to add, frankly. I mean, I think what's interesting here is that, in fact, what I really like about all the three organizations represented here is that they've been at the forefront and kind of leaders in the data space in terms of sharing the data, in terms of collecting it, in terms of analyzing it, and frankly making a push for it. CBRE actually, for instance, does a regular analysis of the green building uptake in the U.S. market. They've actually supported research just in terms of things like looking at tenant willingness to pay. And there was an interesting study that came out, by the way, just as an interesting little aside, where they've said that tenants like a whole bunch of different sustainability features in buildings that could act as as an impetus towards a rent premium, for example, but they're willing to pay for two in particular. And I wonder if you want to take a guess. Well, maybe let's not. But one is what we don't have in this room, which is daylight. People really like daylight. They're willing to pay for daylight. And the second is indoor air quality. Those are two things that tenants are actually willing to pay more for in buildings. So anyway, my point is that a lot of organizations are trying to lead on this data front. Bentall Kennedy is in fact we're actually sponsoring some research at a research institution in Canada where they're using Bentall Kennedy's data, for example, and Fannie, of course, has been sharing the data and analyzing it too. So I think if I were to make an appeal to particularly the people who are at the top of the food chain in this conference, and there are a lot, all you asset manager types, who wear expensive suits, I think what you should do is just make a push, as opposed to us poor researchers, make a push in your organizations to collect these data and make them available to analyze them, because there's nothing as powerful as empirical evidence for moving these things forward. So that's one pitch I'd make.
All right, why don't we stay with you for a second?
Yeah.
So let's coming back. We're gonna be a little more sector specific. So you look forward in this commercial lending thing. What are the next steps for you? So far you have found a significant relationship between certain measures of energy efficiency and certain measures of default risk. What help folks anticipate where that line of research goes? What's next for that?
Yeah, that's in fact that's always, it seems, the issue with efficiency and sustainability generally, which is what next? Once we've shown, efficiency's been proven to be cost effective for decades. Honestly, there's nothing much new there. Yeah, a few new technologies come out, and we always show that it's cost effective, and yet it doesn't have full market uptake. partly it's an attention span issue. Partly it's just like, do I need? Yeah, it makes sense, but we're focusing on other things in my building right now. So what we're trying to do with working with the lenders in particular is to say that, look, we're not even trying to say advance efficiency or advance sustainability. We know it's not your job. It's just, there's too much else going on. What is in your job is to look at risk as you lend and so on. We think there's a risk you're not properly valuing. We've got a way to value it for you. And we're coming up with a simple risk score, and we're just saying lenders, hey, in your portfolio at least, let's pilot test it. And then where we'd like to get to eventually is that it becomes standard practice in that little space that, just like they have an earthquake score or a natural hazard score, they have an energy risk score for their buildings. And buildings with a high score, again, will have to have mitigating measures, and it sends a signal into the market. So that's really where we're trying to go.
Cool, awesome. All right, Dara, let's come back down this way. So what are you excited about as you you've talked about the general contours of the markets you're in and the kind of general thesis that you're working under. As you look forward, what are you optimistic about? What do you see the opportunity space look like at this time in the market? And
cycle pending. I think what excites me is the ability to tie in sustainability as an alpha metric instead of a double bottom line metric. So I think as most investment management firms, hedge funds, real estate managers, private equity managers, I think the pitch on sustainability from 10 years ago was more double bottom line.
Yep.
And it's been pushed to be more bottom line, but there's not a lot of data to support that, and it's been a very nuanced message around how you're creating absolute value within your respective vertical using sustainability. So I think as more data becomes available and you identify that it is a component of your thesis, or maybe your entire thesis depending on what you're doing, hopefully you'll be able to show this was why we either created value or mitigated risk, didn't lose as much money as some other strategy, or made more money than another strategy. And I think that will be really materially different for everyone who incorporates sustainability into investing, because there'll just be more capital flows. People will incorporate it and it'll affect more of the world around us. So that's my hope.
I like that. So just going to go to stay with you for a second of saying, one of those questions that has come up in this dialogue is sustainable, I was going to say sustainable investing. It's kind of a weird topic. What I mean by that is saying, when you look at the value space that you're in, of investors who express interest in sustainability, are you seeing a reallocation of capital? Are you seeing new money coming into the space? Can you talk a little?
That is a very good question.
Yeah.
I think it depends on who. Who is a big factor. So we're a lot of Europeans, Canadians, very focused on sustainability. So there's this identifying belief because of the nuances on the value creation. Some pensions have that as a major factor now, so there is some reallocation there. There's some family offices that are putting it in the tenets of what they want to achieve, but again, that's a move toward a double bottom line and not an absolute value. So we are seeing shifts in capital flows towards sustainability, absolutely. Some of it is double bottom line driven, which I don't, that only has a certain market share, right? And so, yes, I think the answer is yes, but you'd like to see it be more absolute.
Yeah, that's good. And that's, if you guys haven't followed this literature, just compared to saying, if we were talking about the research connecting property companies to returns 5, 6, 7 years ago, it was a beta literature. It was about volatility and about downside risk. Now we're having this, can we see the contours of this alpha generated universe? It's really interesting. But as you say, the literature is thin, it's not right. Awesome. So let's keep moving this way. So Tsilah, so what is, you just kind of to play off all that stuff and say, look, what do you, when you look forward, like you've talked a lot about the ability to create value by amenities, with community engagement, also in playing into the value space. What catches your eye about moving forward? Where are we heading here?
Well, a couple things. One is relating to what Dara said, is that we recently saw in Europe a mandate for to take EPC rated buildings, lower rated buildings, and to retrofit and bring them up to a higher EPC rating. So, that's the first time we've seen an actual mandate come out. They were going to work with one of the NGOs as well to then look for an investment manager to work on that. But I thought that was an interesting step forward. You know, in Europe, we have a lot of old buildings that haven't been retrofitted and are severely impacted, and yet there's legislation that requires those buildings to be upgraded. So how are we going to make that happen?
Yeah.
So from an international perspective, I thought that's an interesting step forward.
Yeah, and so for folks who haven't followed, the one extension of that, as you're saying, the UK regulation, which creates kind of the ultimate thing of Paul's sort of risk of saying, where this regulation in the UK now says, I think beginning in less than a year or something, where you can't let low-rated energy efficient buildings, right? So we actually literally have a very visceral transition risk and a very visceral risk to the bottom line in terms of being able to create new leases on those properties, right?
Yes.
New York is kind of toying with something that could be interpreted the same, right? Which is interesting, right?
Could I add a comment to that?
Yeah, let's Tsilah go first and then
No,
come back
go
to you.
ahead, Paul,
Okay.
and then I'll come back.
You guys sort it out.
Yeah, no, I just want to add on that particular topic. Even in the U.S. now, several cities, Washington D.C., Seattle, New York, and Santa Monica, are now considering legislation that says that existing buildings have to meet a certain efficiency level. And that means essentially, that's going to create a huge retrofit market there, and it's also going to, affect, again, valuation. Buildings that are below a certain Energy Star score, that will immediately, if they by code, if they have to catch up, then obviously, that's an investment that has to be made, and that'll be a problem from the valuation standpoint. So it's not just in Europe; it's actually coming here as well.
Right. Well, and just a couple years ago, when we had a severe drought in California, the city of Beverly Hills mandated that all building owners had to reduce water consumption by 20%. So what that meant is the buildings that we owned in Beverly Hills, we had to do all that retrofitting to be able to ensure that we met that requirement. It is definitely happening here as well. I did want to talk about also what we've done. We had a property in Seattle, an interesting case study, I think, where there were two buildings. They were on the fringe of downtown Seattle, not a great area. And through renovations and that we did, and really putting the ESG wrapper on the buildings, we created an environment where actually now that area, a few years later, is now considered part of traditional downtown Seattle. What we did was we took an area, we activated open space between two buildings, and not only for the tenants, but also for the surrounding community. So programming that space, making sure that the ground floor retail were things that not only the tenants could benefit from, excuse me, but also the surrounding community. And so that shared advantage, so that Michael Potter talked about shared value, so that we're not only looking at it from the perspective of the buildings itself, but for the greater community. And I think that's the spirit of what we're all talking about in terms of ESG. And so I'm excited about what we're doing in terms of that and the impact that it's creating on communities.
Awesome, cool. Well, so Lisa, we took a long trip down this way and a long trip back this way. But let's talk about where you guys are heading, because you play at you guys play at a lot of scales, but you have a capital markets part and thinking about I'm curious to kind of seed you with asking, where does this go from? What's going on? You guys have created an incredibly viable way to engage the borrower, and almost kind of turning that corner about being like, hey, it's kind of a no-brainer actually the way you guys have it set up right now. At the same time, one of the questions are the appetite for the market for the green bond product that you're creating. How do you feel like that there's kind of two sides of the equation, and where are you heading?
Definitely.
Yeah.
So now that we think we have the borrower element relatively nailed down, we are definitely focused on the investor community. The nice thing about our product is the $40 billion of green MBS that we did could get sold to a regular MBS investor with no concern for green, and generally does. We've had some luck with penetration in the green market, but we are definitely slogging our brains out across the world right now, trying to get more international investors to look at the product. We would like, ideally, when we come to market with the green GEMS REMIC, for example, that all of the green investors are in, or all of the investors are green. So the most recent deal we did in June had so far the best penetration that we had to date. But again, it was still less than 20% of the investors that participated. So that's one of our big future focuses.
What's holding them back? Like, why
So
not?
sure,
yeah.
I think most green investors or folks with a socially responsible investment fund are focused on what has been existing green bonds, right? So they are not as focused necessarily on what they're terming as asset-backed, which is what they're calling us. I think use of proceeds is always a hurdle, right? It's the entire mortgage that is the dollar that you're investing in. It's not just the small amount of investment that went into the green change, because in our mind it has changed the entire building to a green building, as if it had, for example, a third-party green building certification on it. So it's getting people comfortable for that. Also internationally, there's the normal fixed income hurdles of its US denominated, US dollar denominated. That is one hurdle. All of our meetings in the US are focused on explaining green, and all of our meetings internationally are focused on explaining Fannie Mae and making sure everyone knows that Fannie Mae multifamily is not Fannie Mae single family, and that the 2007 crisis, we emerged virtually unscathed in the multifamily sector because it was just a very different animal. That being said, when you say what are we looking to in the future, in addition our single family business, if you think about all of multifamily lending in the United States, it's roughly a $1.4 trillion market. If you think about single family residential, it's a $10 trillion market. The potential impact that market could have on the greening of our built environment is enormous. But to Paul's earlier point, if you think data is tough from a commercial real estate perspective, you should see it on an individual house, right? Trying to convince that person not only to take it, but then report on it in an intelligent, reliable way. So that's our big effort right now. That's what our team is working on. But if anybody is interested in talking about multifamily GEMS, I would be happy to do that afterwards.
Very cool. All right, so I have to be sensitive to time, and I also want to see if just as we close out some comments here, if there are folks in the audience who have a question, please put that in your head. Just 30 seconds, and we'll get to a question or two. I know that we are preciously tight on time in different ways, and so just to give a cross section, I hope what you've taken from the panel's remarks is the breadth and diversity of what constitutes where sustainability, responsible investment intersects with different real estate value. Different pieces of the real estate value chain. And so before we turn it over to audience questions for a second, any just last thoughts that you want to leave people with? So folks who are working on responsible investment and thinking about the property space and trying to connect the two, are there, the comments you had, Lisa, were so interesting. Any last thoughts that you might want to leave people before we go to Q&A?
No, I just think that there's a lot of data out there that people just don't even know about or don't approach. All of our securities are publicly disclosed, all the way down to property level, ongoing annual disclosure. So I'm talking to people constantly who don't realize how available the data is from an investment portfolio management. So I would say definitely dig. It's there.
Cool. Tsilah, what should they know? What should people take away?
I think that we've, energy efficiency is something that we're all comfortable with, and we understand how we need to approach that. I think that the S piece is something that takes a lot of creativity. I think we've been doing that with tenant engagement and how we operate in our buildings, but I think there's more there, and again, I think that's something that more property owners need to be thinking about.
Yeah, we barely even scratched the surface of both upsides and downsides in terms of awesome. Dara, what?
I don't want to be redundant. I guess I would
That's
say
reinforcing.
Yeah. Just with all the data information and employment of ESG and real estate, being mindful of how that will affect the cost of capital for the business, I think is going to be transformative.
Yeah, very interesting. Paul.
Yeah, and I think maybe my last point I'd make is just that, first of all, there is actually good evidence already of these linkages between value and green and sustainability features and so on. I think what we're lacking, or where there's a gap, is in more acting on those data and on that information. And I think there are effective ways to do that. So the first question is just, especially if you're an asset manager in a position of influence and so on, is to at least ask the question if it's not being asked, and ensure that efficiency and sustainability are just properly valued in your valuation processes.
I think that's a great thought. As we go to the audience for questions, that's one of the things about, there's something indigenous to the property space that it's a Lake Wobegon effect. We're all above average. And if you ask someone about their property company, they're all great, but when you dig under the surface, they're not. The assets aren't the same, the companies aren't the same, the way they manage these issues isn't the same, and that heterogeneity of activity is that source of arbitrage or competitive advantage and whatnot. And so it is there if you dig for it. So question, yes, please, go for it.
Paul, thank you for the action. I will, as an investor in sustainable real estate, ask the questions to the company. None of you are REITs, though, so I can't buy you. But anyway, still, the question is, how are you guys dealing with physical risk with the TCFD and all that? And where in your processes, both on acquisition, retention, and disposal of assets, are you looking at physical risks and how you're dealing with that? And if you can speak to it, maybe how that plays out with the tenant versus owner dynamic. If something's underwater, the tenant's still paying you rent, et cetera. How does that factor into your thinking?
And just to add one thing to Sam's comment, which is really cool, is if you haven't seen, there was a blog that Nils Koch put out on the website called Geofi, looking at the exposure of different U.S. REITs to Florence as they came in right now, and the availability of that information in real time is pretty damn good. So thinking about what Sam said, so what's going on with this with this side of the equation? Anyone have a reaction? Thinking? Tsilah, you brought it up earlier.
I could just say that I'm just thinking about when one of our buildings got hit in Houston with a severe storm. And the issue that what we did was we made sure that we kept our investors informed and the tenants informed, and we have a system in place so that when there's an emergency event, that we know what escalations need to happen so that we're on top of the event. And also I think what it comes to though is putting those mitigation measures in place before an event. So if you're in Houston, right, there's a higher likelihood of a potential weather event and flooding. And so the building that we've bought, do we have the measures in place to mitigate flooding risk? Do we have the insurance in place? All those issues have to be thought of when you're acquiring the building first, and then as you're managing it. So the same thing if you're in Miami, right? There are issues, and you want to be sure that those buildings, that you consider those risks when you're when you're buying the property and as you're managing it.
Yeah, and the one thing, this is something we've been working on very closely, as you know, Sam, the last couple of the week, GRESP week. And the thing is that I would just point one quick reaction is saying there is a huge difference between what companies are putting in their 10K describing how they're doing the things that Tsilah is saying, and when we dig a little deeper and ask them to unpack the governance, the risk assessment, the strategy implementation, and performance measurement, those two things are wildly different. So if we're getting that information today by just kind of taking a peek at the 10K and seeing what folks say, that boilerplate is not the same as the other piece. So we can talk about that. Others, quick. And I'm sensitive to maybe one more question. Someone's got a last one. Not, I'm going to inflict one. Please.
Thank you,
everyone. Yeah. Thank you.
Thanks. My name's Lucy Thomas from Treasury Corporation. You mentioned that you were kind of scratching the surface on the S. I know we don't have much time, but it would be interesting to just hear a little bit more about what you're thinking about under S, and obviously this only moves forward when you can map that then to some underlying value or risk factor that would be good to hear. Thank you.
So can I actually engage both of you guys? You both have a story here, I know.
Do you want to?
Sure, I think for us, it's an interesting topic just because we are essentially an S company. But to your point about data, right, we mark our affordability generally off of percent area median income. That's one of our tickers, and we do have data on that. So we could essentially do social bonds on that. I think to Tsilah's point, though, we do have a healthy housing initiative as well, where we're trying to figure out how can we create these communities where it's more than just one solution. And to my neuroses about green data, social data is even tougher, right, from an investor's perspective. So every time it comes up, I try to bat it away and task people to focus on green. But I think it is a huge opportunity for us, and I think in the market in general, because it exists already in the United States. It's just a matter of quantifying it and being able to bring it to market. But if green is here, S is way down here in terms of readiness.
So we do a Kingsley survey of our tenants on an annual basis, so for tenant satisfaction. And what the data shows that satisfied tenants renew 2.8 times more frequently than unsatisfied tenants. So to keep your tenants satisfied is a critical bottom line issue. And so now what I see is that we're moving more into a hospitality environment. And so especially in our office buildings and in retail and multifamily, that we need to, it's the concierge approach, that we're providing our tenants and with the programs that they're looking for, that we have the amenities that they're looking for. I was telling Chris yesterday that we've moved our property management offices from the bowels of the building, the least used space, to ground floor up in front, so that our property managers, as tenants are coming into the building in the morning, they're there greeting them and so that they can come and say, oh, Joe, we have a leak in our, or we have an issue. And then our people are on top of it immediately. We do a lot of training for our leasing agents, for our property managers, and for all the building staff, so that again, it's like a family, and that we're there to support the tenants and make it a livable environment for them. We've created spaces where people can come in our office buildings, or they can come and sit and talk and just connect, right, outside of their offices. We've created programming for the tenant employees. And what we found is that we're in a market where what's important to tenants is keeping talent, right? Because it's in a low unemployment environment, that's important to the tenants. So by our creating programming that the tenants, employees really enjoy, and an environment that the tenant employees want to be at and to spend time at and are more productive at, that helps the employer. And so that tenant, again, will be more satisfied, want to stay in our buildings, means less tenant improvements, less renewal costs, and then again, that relates to our bottom line and higher returns.
Cool. Any quick last comment from Dara or
No,
from?
I mean, you said it all.
All right. Well, cool. I want to respect that we are at or over our time. So I appreciate you guys making time on a Friday. I hope please join me in giving a round of applause for our panelists. Thank you very much.